Why would we ever want an adjustable mortgage when we could just lock into these historically low interest rates that we are seeing today? You can lock in for a good rate for 5, 10, 30 years, and then there'll never be a threat of interest rates rising on you. In the world of value-add apartments, not so fast. There are these 3 punitive laws, I believe they're referred to as invest for cash flow. You want to make sure that you have plenty of capital reserves. And number 3, you want to secure long-term debt. But it really isn't accurate just to say that, because it depends solely upon your business plan. And in value-add apartments, we're looking to increase the value after we complete our business plan. And a business plan may last 18 to 24 months. And by the time operations have been improved and the renovations have been completed, now you can go back to the bank and seek that refinance, or maybe you've done so well that you could put it back on the market and sell at a profit. But if you have long-term debt, there's a catch. There are stiff prepayment penalties that are so stiff that they'll completely wipe out investor returns. So to say that you need long-term debt, it really depends. If you have what's called a yield play, and you're just investing in a building for cash flow, and there are no renovations needed, then yes, maybe a long-term fixed debt plan would make sense. But most times, at least when we're involved in purchasing a building, we're looking at something that needs a little love, and we're going to go in there and we're going to upgrade the building, bring it up to market, and therefore we'll be able to charge market rents. So again, if your plan is to go in and renovate the building, increase its value, go back to the bank and seek a refinance or put it back on the market, if you have fixed debt on the building, your hands are going to be tied because of those stiff prepayment penalties that I mentioned. So the workaround for fixed debt is floating rate debt or short-term bridge debt that will bridge you into the next loan. And right now you're thinking, well, in this inflationary environment, interest rates can only go up from here. And you're probably right. So we have to compensate for this potential rise in interest rates in our underwriting. And we can accomplish this by using a forward curve, as demonstrated here on the right. There are a couple of acronyms called SOFR and LIBOR. I'm not going to get too deep into that, but they are forward curves that we look for forecasting and underwriting floating rate debt. Both curves, by the way, they reflect future expectations of the Federal Open Market Committee policy. Again, I'm not going to get too deep into what SOFR and LIBOR mean, but think of them sort of like a prime rate, and that the lenders add their points to make their money and to create the spread and the effective interest rate that the borrower has to pay. So here on the right, this is sort of an example of where we can get this data and plug it into our model. There is also, this is called Chatham Financial, by the way. They have some cool tools. You see here, they got market rates. You can see US forward curves, which is what we're looking at. They have some other nice things as well. So, and you can isolate it down just to SOFR. And you can see there down here that this projects out quite a ways. Also like to use this one, which is pensford.com. And you can see if your loan, for example, was to start on September 21st, 2021, you would plug this into year 1, and then you go a year out, and you plug this into year 2. This is incrementally above your current interest rate. So to display how this actually works, hopefully you're working with a model or your operator is working with a model that has this included. In this case, the loan was SOFR, and you can see here, year 1, we plug that in. So this is over and above. I believe the interest rate began at 2.44%, which is pretty attractive. But again, to compensate for future rising interest rates, we've gone in here and we've plugged in the data from the SOFR forward-looking curve. And this way, these guys, these returns here, are not affected. Otherwise, you're not going to look good. And worse, you're just not going to meet your returns. So again, this is how we compensate for potentially rising interest rates into our pro forma and future projections. Stop sharing here. This is definitely, a question that you want to ask your operator if they are using floating rate debt. You just want to make sure that they are accounting for potential rises in the cost of borrowing. So I hope you found that beneficial. If you have any questions, definitely reach out as always. Thanks for tuning in. See you next time.